Good day. It's Chapter 3, the Accounting Information System. Now, our study objectives today. Analyze the effect of business transactions on the basic accounting equation. Explain what the account is and how it helps in the recording process. Define debits and credits and explain how they are used to record business transactions, and identify the basic steps in the recording process. To begin with, the accounting information system is a system in which we collect accounting information, we process that data, and then we communicate it to people both inside and outside the business. Most businesses use a computerized accounting system. It's called EDP. Now, what we're talking about here are transactions. Now, a transaction is an exchange. It's an economic event in which there has been an exchange. Now, not all activities are transactions. Assets, liabilities, or stockholder equity items change as a result of economic transactions. There is a dual effect. Two counts are affected with transaction. Now, the question. Are the following events recorded in the accounting records? The first one, I purchase a computer. Does this have any effect on our assets, liabilities, or shareholders' equity? Yes, my equipment has gone up. So therefore, I must record that. I discuss a trip with options with a potential customer. Just discussing this, has this changed any of our assets, liabilities, or shareholders' equity? No, so I do not record it. In the third situation, I pay the rent. Does this have any effect? Yes, rent is an expense and it allows me now to use this building for a period of time. So yes, this is recorded. So you see, not all transactions are recorded, only those that affect assets, liabilities, shareholders' equity, revenue, or expenses. Now, analyzing transactions. The process analyzing these, we consider the basic accounting equation, and that is assets, which are on the left-hand side of the equal sign, equal liabilities on the right-hand side of the equal sign, plus shareholders or stockholders' equity. That's the basic accounting equation. Notice, one side of the equal sign, the other side of the equal sign. With this equation, we can now record all business transactions. Assets equal liabilities plus shareholders' equity, but remember we have shareholders' equity in two parts: common stock, which the shareholders invested in the company, plus retained earnings. Now, retained earnings is determined by revenue minus expenses minus dividends. Now, the accounting transactions. Let's assume on October 1st, cash of $10,000 is invested in Sierra Corporation. We're doing the accounting now for Sierra Corporation. This investment was made in exchange for 10,000 common stock. So what happens to all the accounts? Look at the accounts I have under assets. I have cash, supplies, prepaid insurance, equipment. They're on the left-hand side of the equal sign. On the right-hand side of the equal sign, I have notes payable, accounts payable, unearned service revenue, our good old friend unearned revenue. Notice it's a liability. Common stock, and now revenue, expenses, and dividends are under retained earnings. So how is the transaction? This is a transaction because it affects two accounts. One, cash, and cash went up. And the other, common stock, and common stock went up. So you see there's a plus on one side of the equal sign and a plus on the other side of the equal sign. So we're in balance as long as one side equals the other all the time. Second transaction, October 1st, Sierra bought $5,000 from Castle Bank by signing a 3-month 12% $5,000 note payable. Don't worry about all that. We'll learn about notes payable later on. Well, we borrowed the money, so our cash went up. But now our liabilities also went up. Notes payable. Again, a plus on one side equal a plus on the other side. We're in balance. And that's the thing about accounting transactions. Every transaction is balanced. It affects two accounts, but it always affects it such that the assets will equal the liabilities plus owner's equity. Third one, we purchase equipment by paying $5,000 in cash. Well, our cash goes down $5,000, but our equipment goes up $5,000. Now notice, on one side, this transaction only affects the left-hand side, assets, but it affects it so the one asset went down 5, the other went up 5. We're still in balance. Okay, number 4, we received $1,200 cash advance. Remember cash advance? Unearned service revenue. Well, our cash went up $1,200, our unearned service revenue went up. One on $1,200 on the left, $1,200 on the right. Number 5, Sierra received $10,000 in cash from Copa Company for guided services performed. Well, cash goes up, but revenue goes up. Do you see? Equal sides. Number 6, Sierra Corporation paid its office rent for the month. Well, cash goes down and expense goes down. So they put a negative over here under expenses. October 4th, Sierra paid $600 for 1-year insurance policy that will expire. Well, cash goes down, but prepaid insurance goes up. Again, a negative and positive, but both on the same side of the equal sign. So we're still on balance. Number 8, we purchased supplies on account. Supplies went up $2,500, but our liabilities went up $2,500. We paid $500 dividend. Cash goes down, dividends goes down, a negative and a negative. Retained earnings goes down, so it's a negative and a negative. Have worked 2 weeks earning $4,000 in salary. Cash goes down, and retained earnings goes down because the expense. And when we total it all up, you'll notice on the equal sign down below, we have $23,300 on the left-hand side, $23,300 on the right-hand side. And that's how we record business transactions, using the balance sheet equation. Assets equal liabilities plus shareholders' equity. Now, we're going to look further at what's called the account. We're going to look at each account separately. An account is, think of it as a T. Across there is the name. Down we have the left-hand side, which is called debit, and the right-hand side, which is called credit. Now, I told you that this is a new language. Debit actually means left in Latin, and credit actually means right. We're going to use this to record the increases and decreases in specific asset, liability, equity, revenue, or expense items. Debit is left, credit is right. Credit and debit procedures. In a double entry system, each transaction must affect 2 or more accounts to keep the balance in the accounting equation. Recording is done by debiting at least one account and crediting another. At all times, debits must equal credits. Now, when we look at a debit account, if this is a debit account like cash and it has a 10,000 debit and an 8,000 debit and a 3,000 credit, this is a debit account. The balance is 15,000. If you add up the left, you have 18,000. If you subtract the right, you have 3, so 18 minus 3 is 15,000. That is a debit balance account. A credit balance account is the opposite. And here we have credits of 3,000 and 8,000 on the right-hand side and 10,000 on the left-hand side. So the right exceeds the left by 1,000. This is a credit balance account. These are the rules here. Because assets are on the left-hand side of the balance sheet equation, the rule is, and this is just a made-up rule, that any increase in an asset is recorded on the left-hand side. If the transaction decreases an asset, we simply record it on the right-hand side. We don't use pluses or minuses. If it increases, on the left. If it decreases, on the right. The opposite is for liabilities. Liabilities, if a transaction increases a liability, we simply record it on the right. If it decreases a liability, we record it on the left. Shareholders' equity, same thing as liabilities. Because it's on the right-hand side of the equal sign, it increases on the right-hand side of the account, the T account, and decreases on the left. Now, shareholders' equity is common stock, which it goes up on the right, but retained earnings, which goes up on the right, and dividends reduces retained earnings, so it's opposite. It goes down on the right. Okay? Now, to look further to the retained earnings, we have transactions that are revenue transactions. Well, a revenue transaction increases retained earnings, so it goes up on the right. An expense decreases retained earnings, so it goes up on the left. It's the opposite. Now, there is never a transaction where revenue goes down, and there's never a transaction where expenses go down. So you don't have to record the decreases in revenue or expenses. You just remember that every time you earn revenue, you credit revenue. Anytime you incur an expense, you debit expense. That's all. So your normal balances then, assets have a normal debit balance, and expenses have a debit balance. On the other side, liabilities have a credit balance, shareholders' equity have a credit balance, and revenue has a credit balance. So you just remember that assets go up on the left and down on the right. Expenses only go up on the left. They never go down, so you don't even think about the right-hand side of the expense account. Liabilities go up on the right and down on the left. Shareholders' equity go up on the credit side, down on the debit side. And revenue only goes up. It never goes down, so you always credit revenue. You never debit revenue. So here's the summary of it. Assets up, expenses up, liabilities and owner's equity down. They're debit balance accounts, okay? And it's the opposite for the other three. So therefore, relationship between the assets, liabilities, and shareholders' equity. Assets are on the left-hand side. They go up on the left-hand side. Liabilities and shareholders' equity are on the right-hand side. They go up on the right-hand side. All right. Now, never mind the plus and minus. But if we have equal debits on the left-hand side of the equation and credits on the other side, we're always in balance. And that is the way we record. We take the source document from what happens, a sales slip or a check or a bill that provides evidence. We analyze each transaction and we enter each transaction into a journal, and then we transfer that journal information to the ledger. Now, part two, we will now look at entering into a journal, and in part two, we will look at putting it into a ledger. How do we do this? A journal is a book. It's like a diary in which we record daily everything that happens in the order in which they happen, chronological order, that is the order in time that it happened. This discloses the complete effects of a transaction. Okay? Journalizing means we enter the transactional data into a journal. An example is best. First of all, Sierra issued common stock in exchange for 10,000 cash. Then they borrowed 5,000 by signing a note. So October 1st, one transaction. Cash goes up, we record the debit first. Cash, debit, 10,000, shareholders' equity, or common stock, credit, 10,000. The next transaction, we borrowed 5,000. Well, cash went up, 5,000, notes payable, credit, what's a liability? It went up, 5,000. October 2nd, we purchased equipment. Okay, now this time, cash goes down, equipment goes up. We always record the debit first. So debit equipment, 5,000, it went up. Credit cash, 5,000. That's how we journalize. That's it. End of part one. Thank you. Shift F10.